September 15th, 2023. Bulls tried to get a wedge open. You can see they attempted to get one push down, two pushes down, and tried to reverse up on 13 and tried to make the breakout down fail on 16. But they failed. And so when you have a failed attempt at a wedge and a breakout below a bull flag, oftentimes you're going to get a measured move down. You can see that's pretty much exactly what we got today. Additionally, this is also a type of wedge. Some will just look at it as a trading range that broke out to the downside, and that's fine too. But if you're looking at it as a wedge, you know that this wedge actually ends up succeeding. And whether if a wedge is successful, let's say we start to get a reversal up, traders will look for a measured move up the size of the wedge. And if the wedge fails and you get a breakout down below the wedge, traders will look for a measured move down at the wedge. And so you can see whether you want to call this a wedge or a trading range, it's fine. It doesn't matter. As long as you know when you see bar 43, it's a big bear surprise, probably likely to get a second leg and potentially a measured move down. You know that you might get a measured move down of the wedge, this second wedge. And the really important thing to note is that, The really important thing to note is that when we broke out below this 16 low, there were limit order bulls who bought below the 16 low, who were hoping to buy more lower and trying to get out at break even. And you can see over here, the high of this bar is 45.1925 and the low of this bar is 45.1925. And it needs to go one tick past where their initial entry price was in order for those traders to get filled. And it wasn't able to. It kept failing at that spot. And so what some institutions will do is they'll sell like one tick below 16, hoping that the gap will stay open, basically that it won't go one tick below the 16 low. So they'll sell, just zoom in a little bit. They'll sell, place limit order to get short right here and have a stop right here. And basically they're just hoping that this gap stays open by one tick. And you can see on bar 39, they would have gotten filled. And, if you're risking 2 points, or sorry, like 2 or 3 ticks, it's logical to scalp for 2 or 3 points down here, which is what a lot of them did. But some of them will hold and just hope they get a swing. And you can see this trade doesn't work very often at all because the risk is so low. And so you just almost always get stopped out. But every once in a while, something like that will work. And, you make back your money and more. That's why they do it. Bar 1, it's the doji bar. Big tail on top, big tail on the bottom. So probably sideways. Bar 2 is an inside bar, but I think it's hard to want to sell after, you get a doji and then an inside bar that doesn't close on its low. But it is the open of the day. And when you get IIs on the open, I only have a couple examples. I'm sure it's pretty low probability. But all the examples I have worked. So you can see this one on bar 6, we got an inside bar, and that was the opening swing. You can see here, basically we got an opening bar and then an inside bar and an inside bar above the moving average, and then a bull swing basically was the low of the day. And here we got an inside bar well below the moving average, and it was a bear swing. So these inside bars definitely aren't very high probability, but some traders will take them just because, sometimes this is going to happen and you're going to make 5-6 times your risk. Follow through on 3, maybe okay to sell at the close of 3. You're starting to get, consecutive bear bars. So more follow through on 4. But tails, tail here, tails here, tails here. So, I'm not sure how much longer this is going to last. An inside bar on 5, kind of a tough call if you're short. You don't necessarily have to get out, but there's probably buyers below and there's probably sellers above, but every once in a while you're going to get a bounce here. And so a lot of traders might exit above, but you know that there are going to be buyers buying below this bull bar, far below the moving average. And you can see that's what happens on the tail on 6. Bulls buy below this, they buy below the breakout point below 4. So bounce up on 7, but probably sellers above 6, probably buyers below 6 if we were to get down there. And you can see we get 8, probably buyers below 7. And you can see the traders, they'll buy below 7, they'll buy more, a couple points lower, maybe 5 points lower. And then on bar 11, anyone who bought below is able to get out with a profit. You can see that. So you get 9 is good follow through for 8. But you have to keep in mind that these traders are probably going to make money if they haven't already. So it's more likely that there are buyers below 9 than there are sellers below 9. We're also towards the bottom of the bear channel. So, you got to be careful when selling the bottom of bear channel. It is a tight bear channel though. So if you're going to sell, it's probably okay, but you're going to have to sit through a pullback. Probably buyers below 11. You can see we went down and then reversed back up on 13. It's a double bottom and it's a wedge double bottom at this point at 13, but it doesn't close very strong. And 10 to 13 is a tight trading range. And I don't really want to buy at the top of the tight trading range. If this is going to be a big swing, which is if you're buying above 13, you're basically saying, you're hoping for a big swing because it's low probability being, bad signal bar, tight trading range. So if you're buying above 13, you're hoping for a humongous swing. And if you're going to get a humongous swing, there's going to be, 30 bars to get in or 20 bars to get in. So just buy a couple bars later. There should be 20, 30 bars of profit. So just buy a couple of bars later. Think about if you had sold, it's kind of like selling below 7. It's like you might get a giant swing down. Well, it's not really like that, but this is a terrible example, but I'm going to use it. It's like if you sold below 7, if you do something like that, you're just hoping for a giant swing down. And you might occasionally get it, but doesn't it make more sense to wait for follow through like 8 and 9 before selling rather than selling directly below here? Because this is an increased probability and you're not really giving them that much potential profit and you're going to save yourself a lot of losing trades. So I hope that made sense. Bad follow through on 14 for those who bought above 13. And you can see on 14, if you bought above 13, 14 is extremely disappointing. If you bought above 13, you want to see a giant bull bar closing on top. You want to see basically the opposite of 17. You want that right here. And you can see that when those traders did not get that on 14, they immediately just sold. They clicked sell the market and just flattened. And that's what caused 15. Now, you could sell 15 hoping you're going to get a breakout below the wedge and a measure move down. I think that's a reasonable thing to do. But if you're going to sell below 15, what do you do when you see 16, right? Because, if you're selling below 15, you're hoping for a breakout below this wedge. This is currently the breakout point and a measure move down of the wedge. But when you get bad follow through on 16, the breakout has now failed. So a lot of traders might try to exit at break even. And you can see any trader who did exit at break even saw the market starting to go down and they panicked thinking that they got trapped out of a good trade and they just sold the market again. And that's what causes this big collapse down on 17 and 18 and 19. If you're short for any reason, you should pretty much be asking yourself the same question that everyone else is, which is, are we going to get back to the 16 low? Why is the 16 low important? Because limit order bulls bought there. And if limit order bulls bought there, they want to buy more lower and try to make money. So when you see a breakout, breakout below a bull bar, you should just be sitting there asking yourself, are we going to get back to the 16 low? Because that's extremely important. And so you get a first reversal up on 20 and then a first reversal down, low one short on 21, but it's not that good. I think that after this spike, we're probably going to pull back for a couple of legs. So I would rather wait. And you get 22. Basically, anyone who bought the close of 20, disappointed 21, gets out during 22. Anyone who bought above 20, disappointed 21, gets out during 23. But you now have a double bottom, and 21 is the neckline of the double bottom, which means it's the highest point between the two bottoms, 20 and 22. And so, some traders will buy the breakout during 24. Some traders will buy above 24. And the reason they're buying is because they're betting that we're going to test this 16 low. You get bar 25. It's a low too short in a bear channel, but I think that this is a pretty tight bull channel within the bear channel. So I would rather rather not short below 25. If you do sell below 25, you're probably gonna have a chance to get out at break even, which is probably what 30 was doing. But bad follow through on 26. So anyone who bought below 26 or bought below 25 is now trapped on 26. And when those traders see, 26 forming a disappointing bar, a lot of them just flattened basically on the close of 26, and that's part of what causes the bounce. Weak bear stops are right up here. If you're a bear, you probably need, if you're selling this, two ways to manage it. You can either flatten pretty much immediately, like the bears did here, who caused this, or you can sell more higher and look for it to get back to your initial entry price. Essentially, if you sold below 26 and you sold more higher, that's what 28's doing. It's when you sell here and you sell here, your average entry price is here. And when it gets touched on 28, those bears who were disappointed are buying back their shorts right around here, thinking that this gap is going to close now. So bears are buying back shorts here. That's what causes the rally on 28. We now have 3 pushes up and a wedge at 29, but this is a pretty tight bear bull channel, so I don't want to sell. And 30, it's a bad follow through bar for the bears, but it does something really important, and that is it breaks the channel line. It's a clear break of the channel line. So on a lower time frame, it's a real break of a bull channel or a bull trend line. And so that means that now we can legitimately get a reversal down because it's a major trend reversal on a lower time frame. Bad follow through for 30 on 31, potential double top short on 32. Bad follow through 33, inside bar 34. Bull see a bull channel and two-legged pullback, and then a wedge pullback at 37. But what's really important here, I wouldn't worry about selling anything in here because I think it's better to start to wait for follow through and clarity that we're going down, or for us to close this gap and then see what we get. So 37, 38. It's I get the logic for buy or for wanting to buy above 38. It's a wedge. It's a failed wedge. And so you're thinking maybe we get a failed measure or failed wedge and a measured move up. But 38 doesn't break out of anything. 38 needs to break out of the 29 high, in my opinion, to buy it. And you see, it just doesn't do enough. It doesn't break out. So without that breakout, I don't think 38 is a very good buy. Additionally, it's 37, down on 38, up on 38. So it's doing this. And so, it's two legs up is my point. So if it's two legs up, it's less likely that we're just going to rally straight up. So that makes it a little less appetizing, as well as the fact that it didn't break out. And, you essentially get attempts at a wedge on 39 and 41. I wouldn't sell 41. You probably can, but the reality is if you're going to sell 41, you probably also sold 29. You probably also sold 25. You probably, maybe you even sold something like 32. And so, yeah, great. You're going to make a bunch of money on 41, but the reality is, this trade is very low probability, and you're just going to end up losing a pile of trades beforehand if you're going to take something like this. So I think it's better to wait for 43. You can see even if you sold 41, what are you going to do on 42? That's not the follow through you wanted, and so it's a low probability trade with bad follow through. It makes more sense to just get out, and a lot of those traders did get out, and that's what's causing 43. Additionally, what's causing 43 is if you bought below 41, did you really want to see 42? Not particularly. What you probably wanted to see was an outside up bar. But, let's say you buy below 41, you bought more below 40. And so you have a small profit here. And a lot of those traders will see that and be disappointed in the bear close, and they'll just sell at the market and take their profit. And that's another thing that's causing 43. When you see 43, you kind of just got to get short. It's a big bar, so the risk is big. But if you trade small, and you won't end up risking any more than any other trade. The important thing to remember too is that it's a breakout below the 42 low. And so, there's trap traders who were buying below here, and now they're trapped in, and they might have to start covering their longs. And something else that's interesting to keep in mind is that, I forgot I was going with that. But anyways, big follow through on 43. You kind of just got to sell the close of 43. Think about if you really think about it, what are you going to get after 43? What are the bulls going to do that's going to make you want to buy? There's pretty much nothing they can do that's going to make you want to buy after bar 43. And, you have to put a stop above 43, which is pretty far. But the reality is, if you're going to take a loss on this trade, it's probably just going to be on the next bar. On bar 44, sometimes you're just going to get a bull reversal bar closing somewhere in here, and you just exit above it. Or you get kind of bad follow through and exit at break even. So if you sell below this bar, and you put a stop up here, your stop's almost never going to get run if you have reasonable management. Follow through on 44. Okay to sell the close 43. Okay to sell the close 44. We're clearly probably going lower. You're looking for a measured move down. Okay to sell the close 45, 46. It's just basically a crash at this point. And it's, sell for any reason. And then you get 48. 48, whenever you get a doji bar after a sell the close kind of thing. After a sell the close sell off, if you get a doji bar, you can expect the market to probably bounce within 3 bars. So it makes sense to take profits maybe below bar 48 or sometime during 49 or above 49 because you're now expecting sideways trading after that doji. Additionally, something to keep in mind is that there are traders buying and selling for any reason at any time. And so, it's logical to think that traders would buy below this 37 breakout point, right? Just the same reason they'd buy below here, they're probably buying below here. And, that adds an extra set of traders that's trapped. But this is it's a bear channel for sure, but it's also kind of a trending trading range. And so traders should be able to get out at break even. And when you take a reasonable buy like this, if you're willing to scale in lower, you have an 80% chance of the market reaching your midpoint and a 60% chance that it just gets back to your initial entry price. And you can see the midpoint being if you buy above another bull bar. And you can see if you bought below here and you bought above a bull bar closing near its high here, you were basically, I think it was one tick away from being let out at break even on 51. And the reason it doesn't quite reach it is because if you bought below this, you are extremely disappointed in this. And so traders just got close to their break even and took the one tick loss. 49, I wouldn't buy above 49, but I would probably get out of shorts. We're probably going to get at least, a two-legged correction maybe to the moving average because, like I said, doji, so expect sideways within a few bars. But if you don't exit above 49, you definitely got to get out above 50. Follow through for the bulls on 51. They're trying to get back to the 19 breakout point, but you can see they were never able to. So that's our second open gap on the day, but it's pretty late in the day to be getting it. And it's basically just turns into a spike in channel. You could argue this is some sort of spike in channel, but it was more of a spike trading range wedge pullback versus a spike in just a bear channel. I wouldn't sell any of this. I think that, this is two legs down. It's hard to want to sell 56. I wouldn't sell 57 either. I don't think we're going that much lower. It's probably going to be sideways. If you do sell 57, or you sell anything in here, you have to get out above 60. It's a double bottom. Your premise isn't valid. We get basically a wedge pullback to the upside and then an attempt down, but it fails. So we get two more legs up and then an attempt down on 73. You could maybe sell 73, but, I don't really see the point. It's pretty late in the day and we're in a tight trading range. There's logic to it for sure. The setup looks okay, but the context being that we're already pretty oversold today, it's just not that good to be taking that short. And anyone who does pretty much just scalps out a new low here. So that's kind of a tough trade to want to take. I would just sit flat. On the daily chart, you can see that, I've been saying this magnet and this high were going to be important, and we just blew right through them. But it's something to keep in mind is that this is a trading range, right? And we are it's kind of in a tight bull channel as well. Or it's not that tight, but it's a bull channel. I guess it's a little more of a triangle forming. But regardless, it's a trading range. So you know that this low, the 914 low, is probably going to be reached. So there's a low probability chance that on Monday, we're going to get big bear follow through to the downside with another bar that looks exactly like September 15th. And that's going to trap the bulls who bought below 914. What bulls who bought below 914 right now are hopeful is going to happen is they're going to buy here, they're going to buy more lower, and they're going to get a reversal back up to this low. Sorry. This is the weekly chart. I just changed the symbol because the current contract. This is the actual current contract, but /ES is supposed to give me the current contract, but it's different for the weekly chart for some reason. I think it's because it shows the last contract. Yeah, that makes sense. This doesn't matter. But this is the weekly chart. You can see we got one leg and we're potentially getting a second leg, but you have an inside pattern, which is a breakout mode pattern. When you get a breakout mode pattern like in II, there's generally a 50% chance the first breakout's going to fail. So if we start to break below this last week, then there's a 50% chance that the breakout down is going to fail. But, like I said, there's a low probability chance that bears just start getting quick follow through tomorrow and we trap those bulls in below there. So that's something to pay attention to. Yeah, that's it.